What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Happy Wednesday. We have some big news in macro, non-farm payrolls, huge revision for today. Also, the Fed minutes are out. We're going to cover those things. We're going to go through a live chart of Bitcoin. We are breaking out a little bit here, so we're going to cover a chart of Bitcoin. The dollar is crashing. Those two things coinciding are interesting duo, so we will cover both of those things, maybe look at a couple other macro charts. And if you guys want me to look at specific macro charts, you can put those in the comments down below. I am live streaming on YouTube, Rumble, Twitter, and Telegram. If you're on Twitter, jump over to Rumble or YouTube, and you can comment there very easily. All right. And then we're going to cover my posts, the two posts that I put out so far this week, other than the fundamentals report, which is on Monday. So we're going to do that all today. Let's jump into it. Let's share the screen. Just start off on bitcoinandmarkets.com. That's where all my stuff comes out. So make sure you guys are subscribed over there. And I also have recently started posting back to the Substack, just pretty much everything. It's the same price to subscribe to the Substack as my own website. They do take a little bit of a cut. So I would prefer that you subscribe to the website, but you can find that on Substack now again as well. All right, so first things first, let's go to non-farm payrolls. And we have a couple sources here. Let me just find them. I had it all set up. Okay, we're going to start with this one. From the Kobasi letter, I recommend, this is a good follow on Twitter for macro stuff, but they came out here. So U.S. Labor Department just revised 12-month job growth lower by a whopping 818,000 jobs. Now, this is the establishment survey. There are two surveys that come out from the federal government on employment. One is from the BLS, that is the establishment survey. And I think the BLS also does the unemployment, but that could be coming out. Oh no, that is from the national. That's from a different agency. I don't remember which one puts out the household survey, but the household survey is what they use to calculate the unemployment rate. So this revision has nothing to do with the unemployment rate as of this time. Also, there was a huge gap that had opened up, much more than 800,000 jobs. I mean, it was I think it was like 6 or 7 million that the gap was between these two surveys. So even in our own single government, there's two methodologies for employment, and they were very, very far apart. Now, that big difference, a lot of what we had thought in the past was that it's due to people taking second and third jobs, because the household survey counts workers and the payrolls counts payrolls, number of jobs. So you can see how if somebody has two jobs, they're going to come up as 2 on the payrolls versus just 1 on the household survey. So this is the BLS establishment survey, and they have adjusted it by 800,000 jobs. That means pretty much all the gains that we've seen throughout the last year or so were fictitious. And those gains were not even for native-born Americans. Most of those gains that we've seen out of the last year have been foreign-born workers in the United States. Donald Trump got in some controversy because he said over 100% of job gains were from foreign-born workers. And people were like, how could that possibly be? Over 100%? Is he retarded? But it actually is the case, because the native-born workers only had they had a 100,000 job decline, where the foreign-born workers gained by 400,000 or something like that. So it was the net change was over 100% of the job gains came from foreign-born workers. But anyway, that is related to this. To put this into perspective, that's a larger drop in jobs than the entire population of San Francisco on a technicality, on a revision. This isn't like that they just went out right now, but they have been miscounting by more than the population of San Francisco. It's also approximately 160,000 more jobs than the entire population of Boston. In fact, the 12-month downward revision is larger than the population of all but 16 cities in the United States. The worst part, the revision is just for the 12 months ended in October of 2024, let alone the last decade of data. And this is the first revision of this data. They are supposed to revise it again next year for this same period. So we could see even more job losses in the data on the second revision. Now, I saw a take from, what's his name? Joe. Oh man, now I can't remember his name. Wenceslas or something like that. It's from he does the a podcast, big podcast from a big news outlet. Now I'm blanking on his name, but he had a good take on this. He's like, all of these revisions, yes, they were bad, they were big and they were bad, but at least there are revisions. Like, you don't even see revisions to Chinese data. You don't see revisions to other data that is fictitious, right? And so at least there is these revisions. And that's kind of my similar stance. I mean, yes, you have to take everything with a grain of salt, but at the same time, if those numbers are in the ballpark of how you are analyzing the macro data, then they are somewhat reliable. And so the same thing with CPI. A lot of people say that CPI understates quote unquote inflation, which CPI doesn't measure money printing, it measures prices. And prices can go up and down for lots of different reasons, including deflation. But the CPI generally matches what you see out there. It generally matches what you see in the markets as well, like on the charts and things. So it definitely doesn't show 10 to 20% CPI rises over the last 20 years like Shadow Stats wants you to believe. Okay, so how long does Shadow Stats have to say 20% before you start going, oh, something not right here? Something's not right with this data. Maybe they were wrong all along and CPI was more correct. Now, CPI is not going to be correct. The jobs data is not going to be correct, but they are attempting to get it correct. And there will be partisan things. There will be politics being played with the numbers. But overall, it matches the ballpark of what the charts and the other data is telling us. So, there you go. That's how you have to interpret these things. I wouldn't trade on a specific number, like say, payrolls is forecast for 270,000 jobs added, and it was only 269,000 jobs added. That means I need to do this type of trade. So I wouldn't trade off this data specifically, but directionality and scope and scale, you can trade off of those types of things. So anyways, that was the jobs report. Now let's go the jobs non-farm payrolls revision. Let's go into the Fed minutes. And for this, I want to jump over here to Financial Juice. I recommend taking a look at their stuff. They had quite a few posts when the FOMC minutes came out. And let's just go through these. Let's go from the first one down at the bottom, and I'll zoom in here a little bit. Oh, and I didn't maximize my screen for Telegram. Sorry, guys. Okay, Fed minutes. Let's go down to the first one. Okay. Fed minutes. The vast majority of participants said it would likely be appropriate to ease policy at the next meeting if data continued to come in as expected, the minutes show. That's one of the big quotes that a lot of people are talking about. So this is more and more likely to come in with the September rate cut based off of this. Next tweet here. Several participants said recent progress on inflation and increases in the unemployment rate provided a plausible case for a 25 basis point rate cut at July's meeting. So at the last meeting already, several people, and some people pointed this out, like, why didn't Powell say this? I think Andreas Steno from Steno Research, he pointed this out. Why didn't Powell mention this in the press conference, in any of his speeches? That nobody mentioned this, but now all of a sudden in the FOMC minutes, several of these people said that they wanted a 25 basis point cut in July. And remember, if you go back and watch our coverage here on Bitcoin and markets, I was saying the chance of a 25 basis point cut was much higher than what people were expecting. And now it comes out that they were saying that several of them were saying they could make a plausible case for a 25 bip cut at the last meeting. So more and more, this is looking like September is locked in. We'll take a look at the odds here in a second. The majority of participants said risks to employment goal had increased. Many noted risks to inflation goal had decreased. So remember, it's a dual mandate. They have stable prices balanced against full employment. So if you have high inflation, you're probably going to have very high employment, actually, because inflation is growth in this system. But it's a balancing act. How much inflation do you want versus how much unemployment do you want? If unemployment starts ticking up, then you might have to start the net balance of your monetary policy should be fighting the slowdown in the economy, the slowdown in employment versus the inflation. Okay. And so what they're saying is what they've been saying for a long time is that they have come into better balance. And now a majority of the participants said risks to employment are greater than the risks to inflation. Once again, very, very dovish. All participants supported maintaining policy rate in current range. Okay, so range. At the end, when they voted, they all supported maintaining the policy. But down here, it said that what did it say? Several participants said that there was a plausible case for a cut. Yet, when it came time to vote, they voted to maintain the policy at the current range. Participants viewed the incoming data as enhancing their confidence that the inflation was moving toward the 2% objective. And I think that the 2% is going to come up a lot faster than people think. I think it's going to come up in maybe even 2 months. I mean, once we get like September numbers, so first week of October, we might be at 2% year over year. We could be negative in the next couple months. All right, let's continue. The Fed staff's outlook for economic growth in the second half of 2024 had been marked down largely in response to weaker than expected labor market conditions. So again, employment stuff is their growth. And we will get a new SEP, which is the summary of economic projections. That's their dot plot. That is their GDP projections, and that is their unemployment projections, things like that. And if you remember previously looking at those charts with me, they all glide down to a nice 2%. It's very interesting. Inflation glides down to 2%. Unemployment glides down to a nice, I don't know, what would it be, like 4% or something. And GDP glides down to 2% growth. So all of these things are just nice glide, soft landing, and we'll see what changed here with this SEP coming up in September. So I think that's mid-September. So that would be in what, 3.5 weeks, 3 weeks from now. Several participants said reducing policy restraint too soon or too much could risk a reversal of progress on inflation. I mean, they got to think of this also. They will be thinking of this also in relation to like the 2-year treasury and the 10-year treasury. Where are those things at? Well, they're way down compared to where the Fed funds range is at. So what is the point? What is the point of keeping the Fed funds range at 5.25% to 5.5% if the 2-year is down at 4%? There's no reason. So this is kind of a wasted statement. Many participants noted that easing policy too late or too little could unduly weaken economic activity or employment. So again, this is typical Fed speak. Oh, we're doing our best to balance. We don't want to do too much. We don't want to do too little. We don't want to be too soon, and we don't want to be too late. Like, it's just obviously grandstanding or positioning, trying to look like they are doing the best thing quantitatively based on data. They always say they're based on data, but if they're based on data, they wouldn't do 25 basis point moves. Okay. If they were based on data, they would do something more specific, like 18 basis points. That would be quantitative, not 25, 25, or 25, then 50, then 25 again. No, it'd be 10, then it'd be 32, then it might be 15. Whatever the case is, they'd be moving this around very quantitatively, but they're not. They're just willy-nilly following the market, one, but trying to build this narrative around, because again, the Fed doesn't do anything mechanical. All they do is a psychological operation, and psychological operations are powerful, but they can't change the basic fundamental reality. See, a lot of people think that the Fed creates the reality by setting interest rates. No, they do not. They create the psychological perception that cannot change the fundamental reality. So if we're going into recession, the Fed can't stop it. If we're going into a boom, the Fed can't stop it. All they can do is psychologically manipulate around the margins. That's all they can do. That's why they're always late, because they literally cannot front run, because they don't do anything mechanical. It's all psychological. Okay, so that was the Fed minutes. What's next? Let's go to some live charts, guys. And actually, before we start talking about this, let me check the comments. Dex Invictus, what's up? Nice one, Zebra, what's up? How do you foresee our technological advances impacting the cost of products and services? Technological advances impacting the cost of products and services. I think technological advance is going to slow rapidly over the next 2 decades, maybe 4 decades, maybe a century. Technological advance is going to slow. One thing that we have done a lot of in the last century is a lot of one-to-manys. If you remember Peter Thiel's book, 0 to 1, once you figure out electromagnetism, like pretty much everything after that has been a one-to-many. That's what we've been building off of for the last 100, 150 years or so. There have been other, of course, different discoveries like nuclear energy. What else? Some medicines. There have been a lot of other things, but the main thing I think that has been driving a lot of the technological advances, when you think about computers, you think about AI, you think about the internet, whatever, Bitcoin, it's just a one-to-many from discovering electromagnetism. You can go back to radar, right? And all the telegraph, all these things are based off of the discovering about electricity. So over the next, I think this is played out. I think even if you look at a lot of the hard sciences, they're kind of coming to this spot where there's a lot of holes that are not being fixed or not being found. For instance, dark matter is one of them. Like they just simply can't find it. There's a lot of problems with other things like the gravitational wave place. What is it? Lido or something like that. There's a lot of questions about their discoveries that are coming out. There's a lot of talk about climate science now, and how climate science is really just a complicated version of studying solar activity. So a lot of these things that we think are so advanced are actually like dead ends, right? And so technological advance, I don't think that's going to be at least it's not going to be nearly as fast as it has been over the last 100 years in the next 20 to 50 years. But how is that going to impact the cost of products and services? Our demographics are going to make products and services more expensive, because the labor costs are not going to be there, are going to be much higher, because there's just going to be fewer workers in the productive ages. And it's going to be worse in developing countries. So a lot of people say, oh, well, we just have Africa. They can, of course, their population is going to double over the next 50 years or 100 years or whatever. That's okay. So everyone else can shrink. But, we're talking about a place with a GDP per capita of 2,000 versus a GDP per capita of 30,000. It takes a lot more Africans to create this GDP than it does in developed countries. And so, no, the costs of products and services are going to go up relative to wages for sure over the next 20 years. Technological advances can't fix that because there's no demand. Demographics are a demand problem. They're not a supply problem. And so AI and all these technologies that promise to do this, they're one, going to be uneconomic. They just aren't going to pay for themselves. And two, that's not the problem. The problem is demand. There's just going to be fewer people demanding fewer things. They're all depressed. They're all, I mean, you could go long on pharmaceutical companies that make like SSRIs and stuff because the population is going to be very depressed. The big industries are going to be stuff where you are, touching grass. Um, that's the stuff, that's the places that are going to be, I think, growing in the next 20 to 50 years. But technological advances for materialistic things, I think, is going to, the cost of those things are going to go much higher relative to wages. Isn't this why they keep debasing our dollars to prop up GDP? Not necessarily, because we usually, when we talk about GDP, we talk about real GDP, which subtracts inflation. So nominal GDP might be like if you go back to COVID, when we had the higher CPI readings, you would have nominal GDP of 10%, but you would have the, say, CPI or the PCE deflator, which they don't use the CPI for GDP, they use the PCE, but they would have that, say, at 5%. So you would subtract 5% off of 10%, and you still have 5% GDP. But GDP is a flawed number. Now, this is an interesting topic, GDP, because it is the king of all macroeconomic indicators. The king. Like, we basically have built our modern understanding of macroeconomics off of the number GDP. And that's not a very good way to measure things. I mean, people are having expanding GDPs with crashing populations. So there's something wrong with the way that we measure GDP. There's something wrong with the way we think of recessions and depressions and growth. Growth is not GDP. Once we started measuring things with GDP, then what gets measured gets managed, right? Your country is going to grow in that direction on purpose because that's what's being measured. So GDP is not perfect and it needs to get fixed. I'm still enjoying the 5+% on my cash. Okay. All right. Thank you. Thank you for joining. Nice 1-0. Let's get back into the charts. Now, this is beautiful what's going on here on the Bitcoin chart. I've been talking about, I talked about this MACD in this last week. I can't remember if it was on the premium content or on the free stuff, but that MACD is crossing over on the daily, looking beautiful. Right at the same time, this RSI now is breaking out, and we're breaking out of this pattern. If we bring up the moving averages, we are right now testing the 50-day moving average once again. We tested it yesterday, came down. On Monday, I said, hey, this is going to be testing these individual levels because back here, they're so close. All of that attention and all the different trading strategies. So some people will sell at the 50-day moving average because they're ultimately bearish. Some people will sell at a 20-day, some people sell at the 200-day, whatever. But all of those strategies are coalescing around a very small area in the chart. And so that is like combined pressure on the price. It's hard to break through this area. Now, once these moving averages start to separate, you can chip away at each one individually. And that's kind of what we're seeing here. We're seeing the 20-day broke, then they came back. It actually closed under the 20-day, but is surged now today back to the 50-day moving average. And I expect it to break here. It's actually slightly above. Let's see where the 50-day moving average is right now. It's at 61,356 and price is at 412. So this is slightly above the 50-day moving average right now, and we'll see where it ends the day. It would be nice to see it get up to the 200-day moving average. And if we let's go to this one. I have to let it load here for a second. Okay, so this is the heat map from CoinGlass. And you can see we had this, the yellow is where there is intense liquidation pressure. So people went short, if it's above. If they went short and they get liquidated there, and price tends to seek out liquidity. And so, yes, it's going to rally right into there. Now we see some building down here, but we will see if we turn around and grab that. We'll actually see how significant that is. If we zoom out to the weekly chart on this, you can see we're rallying right up here into all of this liquidity to grab that liquidity up there at 62,000. So that will be interesting once we get there. And then let's zoom out all the way to the 6 month to get the full picture of this consolidation period that we've been living through basically since the end of February. Really, for March was this major top that I had been I talked about for months. But anyway, so late February up to about March 4th is when this whole consolidation really started, and we're still in that consolidation. But you can see this up top, that yellow is just dramatically powerful. I mean, if you went through this tooltip, shows you all the the different volume here. So at 72,000, there's 650 million in liquidations, 650 at the next tick up. At this one, the brightest orange, there's 800 million. If you just start adding all of these up, I mean, you get into the tens of billions, like 12 to 15 billion in this region, just on Binance and just on the Tether pair. So there is a ton of liquidity up here, and price will seek out that liquidity. So I expect, I mean, just look at the rest of the chart there. There's not a lot of glaring points of interest on this chart until you get up to 70,000. And so that's probably where the price is going to head fairly quickly once we do break that 200-day moving average. That's what I'm waiting for, breaking the 200-day moving average and continuing higher. So back to the chart. Let's take a look at some other markets. How about ETH BTC? I'm not a big altcoin guy. Of course, they're shit coins, but you can see it's very weak and selling off. If we look at the USD chart for Ethereum, way under the 50-day, they're still battling with the 20-day moving average, but very, very weak. This bounce has nothing to it. And actually, let's go do this real quick. We're kind of jumping all over the place, but so this is the Bitcoin ETF flows. You can see the last 4 days, 4 trading days have been positive, not significantly, nothing over 100 million per day, but still positive. Average so far is 114 million per day from year to date of all the ETFs. But if we go to the ETH ETFs, they've had 4 straight days of outflows. They continue to have outflows. Now they're down to 440 million have come out of the ETFs on net since launch. Just absolutely devastating for Ethereum. So I think that that's going to have a lot to do with this cycle as well, that there is not really an alternative. Ethereum is going to follow Bitcoin fundamentals and Bitcoin price movements, but in a very weak fashion. So where Bitcoin's going to gain 10%, in the past, Ethereum might gain 15%. Now Ethereum, I think, is going to gain 5%. It's just going to be the weaker side of the industry here. Okay, what about gold? Gold has been surging. Let's take these moving averages off. Gold has been surging up to 2,500. We'll see where it goes from here. I feel good for gold bugs. I still own my gold that I bought back in the day. And so, yeah, that's good. I like to see this because overall, I mean, we do have kind of a beef here. Bitcoin has kind of a beef with gold. Bitcoin is gold 2.0. Gold has been depressing. I mean, when I was a gold bug, I was depressed all the time about the future. Gold was so manipulated, and you can't beat the banksters and yada, 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 all this stuff. And then Bitcoin shows up, and it gives you a boost of optimism. Like, we can do something. We can change things. We can actually, stick it to the man, so to speak. But anyway, so gold bugs have been holding a long time in a very depressive state. And I'm happy to see that they are getting a bid here. How far up does this go? I don't know. I mean, I've expected gold to rise along with Bitcoin for very similar reasons, just less so. And that is exactly what we're seeing. So hopefully this continues. I'm not going to be selling my gold. I'm one of those people that kind of buys and holds forever. And so, yeah, that is gold. All right, let's take a look at the dollar because it just had some big moves here over the last couple days, and it is crashing right now, down to 101.14. Back here, if we go to the end of the year last year, it hit a low of 100.62. So we're not quite to that low yet, but it is looking pretty bad. And a lot of people, they look at this chart and they say, oh, it's over. See, this is the final move. The final move of the dollar is going to be down. But that's not the case at all. Let's bring up the RSI and, well, not the MACD, but the RSI can show us how oversold this is. And right now we are getting close to levels. This is even lower than when I looked at it earlier today, but the very, very tippy top bottom back here in July of 2023, that was 25.26, and right now we're at 25.22. So we're actually below this low in the RSI on daily. And if you go back here, go back in history, you have to go all the way back to 2020 before that. So these are major, major lows. And most likely this is going to turn into itself a major low for the dollar. It's going to bounce right here. Again, if I bring up, I have a rectangle. There we go. And let me go to the weekly and zoom out. So guys that are new to watching my content, I am a dollar bull. I mean, relatively to most people, but you can see that it moves up ever since the great financial crisis. Something broke with the global financial system during the great financial crisis. Before that, we were in era of expansion, and now since the great financial crisis, we've been in an era of contraction, and it's going to be like an exponential type of contraction. But in that era where the overriding force is deflationary pressure towards a credit bust. So credit bust is deflation, okay? Because money is credit. If you get rid of half of the credit in the world, that's actually getting rid of half the dollars in the world. So it's a deflation event. And as you have this deflationary pressure on this gigantic 75-year credit bubble in the world, we're going to see the dollar continue to go up. Of course, this also pushes people into alternatives because the system is not working, it's not functioning properly. It's the main selling point for the credit-based dollar was its elasticity in the upside. But now when we have downside, there's the inelasticity, the negative elasticity, the shortage of dollars that you have to contend with. And I've been talking about this a lot over the last couple of weeks. So yeah, we're stair stepping. We're just going to the bottom of this range. It's not anything crazy to be expected. I mean, we might see something similar to this type of early part back in 2016. We made a couple lows, then we made a new high, then we made a lower low. We just range bound in there. But yeah, this is nothing crazy like a big crash. To invalidate this theory, we would have to be, breaking down to 97 or so, 98. I would start getting like, what's going on? Maybe I'm wrong about this, but right now we're still in this range, and we're probably going to continue to be range bound for the dollar until something epic happens. Maybe this recession is not it. Maybe we don't even have recession. Who knows what happens in the rest of the year? I think the case for recession is very likely, but we could just be range bound for another 3 years until we eventually break out to the next kind of high zone. That is very possible. That's my base case for the dollar. Now, remember, the dollar can be backed by Bitcoin. So Bitcoin, this doesn't really have anything much to do with the Bitcoin narrative, I would say. Okay, how about we look at the US 10-year, because this has kind of fallen a little bit as well today too. And you can see I called this a multi-month low, or at least a multi-week low back here on August 5th during that Monday panic. And we'll see if that sticks. Let's go to the US 2-year. And I also called this. So, of course, this was a bottom. Another example of TA, and people say TA is silly or whatever, but look at this. I mean, the bottom of this candle is the top of this candle, perfectly horizontal. And anyway, I called the bottom here because of the RSI being so oversold. You can see it's down here at 12, which was the most oversold in many years on the daily chart here for this. And I said it was going to be a multi, like what did I say? Two, like 6 weeks to 6 to 8 weeks. This is going to be a major bottom. Okay. Just a week and a half later, we're showing that there's some selling off here. Look at, you can see this is a lower low on the yields on this candle. So we'll see where this ends up. But overall, I expect this to bounce. I expect this to be stronger than people realize. Of course, it depends on maybe what Powell says on Friday at Jackson Hole and other things. But I do expect this to be a major bottom because of that RSI. Okay. Okay. Next one up is oil. And oil is making new lows back here on August 5th on the great sell-off, the panic event that was, just purely psychological at that point, not driven off the actual fundamentals yet. I mean, that's just one sign along the path towards what we're going to. But we're lower than that here. Overall, remember, guys, we are going to see a dying down of this. So let me mark this up because this is another lower high. And you can see these lower highs. Boom, 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 boom. I mean, it's just weak demand for oil. Peak oil demand is what we're going into. And people like, I'm going to keep saying it, Luke Groman, who has the cheap peak oil theory. I mean, just look at this. We're at $70 a barrel. Trump is in the lead. He's probably going to drill, baby, drill. And the demand in the world is declining because we're going into recession, at least in China, at least in Europe, and a little bit less so in the United States, but it still looks like a recession here. And so demand like that is declining. Plus, we have horrible demographics. Countries like South Korea, China, China, Japan, they're shrinking populations right now. And then if you go to Europe, I mean, they're on the precipice of starting to shrink. So even if you keep the same per capita usage of oil, there's going to be fewer people. And most likely you're going to have less because we're going to be in bad economic times. You're not going to be able to afford as much. And so you're going to cut back as much as possible on your usage of oil. So you might be able to save that marginal trip to the grocery store or something. You save 5% of your oil demand that month. Plus there's fewer people in the world. I mean, this is just and we're plussing up the supply. So the OPEC cuts, there's some that are coming off at the end of this month. So they will be September. They will be back online. Is that correct? I have it marked here. 2.2 million barrels per day in cuts. That ends in September. So October, we're going to be getting 2.2 million more. I mean, we'll come right on the market. It'll take a while to build back up their production, but it'll be within several weeks of the end of those cuts that we'll see 2.2 million barrels more. And then, of course, Trump, drill, baby, drill. So with declining demand, we could see 5 million barrels per day more, 2 years from now. The price of oil is going to be drastically lower. So we don't have peak cheap oil. That's kind of silly. We have peak oil demand, and that's what we've been seeing. Okay, how about stocks? So back here, I called stocks. I said it was total panic, oversold. If we go to the RSI, it actually did not get oversold on the S&P 500. It was 30.55, so barely not oversold. But it is oversold when you compare it to everything else, every other move that there was that we were looking at back then. With the yields and what else were we looking at? Bitcoin. We were looking at several macro indicators. Oil was not oversold. No. But whatever we were looking at, the market in general was overdone and oversold. And so that's what I called that. This is probably near a bottom. And what happened? Just boom, 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 right back up to near all-time highs. Not there quite yet. Let's see, all-time high is on 16 July. And it's interesting. Somebody pointed out that back in 2007, it was also 16 July. That was the all-time high before big crash. Then it came back just barely past the all-time high and then crashed again into recession. So we'll see if that pattern repeats itself here in 2024, but very close to all-time highs. We'll see. Oh, let's take a look. We were taking a look at Japanese yen and stuff. That's what we were looking at. But let's take a look at the Nikkei just real quick. Because back there on August 5th, I said the Nikkei would not come back nearly as much as the S&P 500, and that's what we are seeing. Actually, quite a significant margin between this all-time high, which is a very weird top candle on the Nikkei, but still significantly below that level. And we're on logarithmic, so it's right around 50%. Let's measure this out. And come in here, and we would turn on the 50%, make it white. And how about 7.8? Make that white. And this one, and we'll make this white. Okay, so actually, we are right on this level right here. The 618 retracement fib from the all-time high to the bottom right here. That's interesting level. This comes up in nature, comes up in markets, it comes up all over the place, 61.8. And that's where it topped out. So very interesting there on the Nikkei. Let's go back. Go back to Bitcoin. And then I'm going to take a look at comments and see where we're at. Dex, speaking of gold, Peter Schiff is still hilarious. Like and share. Yes, Dex, thank you. Like and share, guys. Post it out to your socials. Appreciate trying to grow the channels. If you're watching over there on Twitter, jump over to YouTube and Rumble. You can comment over there. It's much easier. Trying to grow the YouTube up to get it monetized and get this show on the road here for the podcast and the live streams. All right. What should we talk about now? Put your comments down below. Let me see if there's anything coming out of Telegram. Nope, not seeing anything over there. Now, Dex was talking about Peter Schiff, and I had one of his tweets. Let's see. Had it on, put it on Telegram. What did I say here? Oh, yeah, he's just talking. Peter Schiff said the U.S. dollar index just hit a new 2024 low. The last time the dollar index was trading this low was December of 2023, but the dollar index is actually still relatively high. No, it's not. It's at the bottom of the range. And but it looks like it's on the verge of a total collapse. Of course, this is linear thinking, as Peter Schiff and others always have. It's going in this direction. It's going to continue going in this direction because my flawed model. And then when it doesn't work out for 20 years, I was going to say 12 years, but 20 years for Peter Schiff, then you're going to say that eventually one day they'll be right and they'll be like, see, I was right all along. But no, you were wrong the whole time. Your model is broken. You're at the bottom of the channel, okay, bottom of the range right now for the dollar. It's not going to happen. Okay, let's go back over to bitcoinandmarkets.com and just read real quick what I talked about here. So yes, this is a post today about the dollar, just a quick post, macro minute, trying to keep them short. We are celebrating the 300 reports. I did report 301 this week on Monday. That's my weekly newsletter that goes out. So you can get a free month of supporting me, just becoming a $5 member, supporting my content with a couple freebies, or get the premium content, which is all of my forecasting and stuff. So you guys can check that out. Dollar dominance. We are often told by many macro professionals, especially in the Bitcoin space, that the dollar is dying and is on its way out. They claim it's only a matter of time before the less evil hegemons rise to challenge the dollar's supremacy. Sorry, but that is not happening. The most likely scenario is that the dollar will eventually be backed by Bitcoin as any cracks begin to appear in its dominance. I found a website you can bookmark, so check that out. I'm trying to give you guys some resources here to keep track of the dollar dominance. The Atlantic Council. So this is a nasty globalist organization, but this page is quite useful actually, and it consolidates all the relative stats in one place and is regularly updated. The last time was on June 25th. You can select from a drop down to check the data of all the major currencies. So check this out. Dollar dominance remains strong, 58% of reserves, 54% of invoicing. And this is kind of a tricky one because invoicing is like, what about Germany and Italy trading? They're going to invoice in the euro. So the euro is kind of artificially propped up in that way. But yeah, the US dollar is 54% of invoicing, and share of foreign exchange transactions is at 88%. So if you didn't have things like euro to euro invoicing, uh, this would probably look a little bit closer to this 88%, maybe not quite that high, but 75% or so. So yeah, share of Forex transactions, 88%. That's just completely dominant. Completely dominant. The dollar dominance in foreign reserves is often quoted, but it is fallacious, and the counter argument is usually the petrodollar. So the reason why we have, the reason why there's 58% of reserves is because of the petrodollar recycling, and of course that's not the case. The petrodollar is kind of a myth. Currently, the dollar still holds a 58% share of foreign reserves, despite China and others being forced to sell off some of their reserves to balance their own currencies. The dollar also maintained 54%. Okay, we talked about that. Dollar dominance remains strong. This is actually the renminbi and their share. I mean, compare this to the dollar, 2%, 4% of invoicing, which I think also includes Hong Kong and stuff, but Hong Kong does have the Hong Kong dollar. So, share of invoicing is minuscule, and share of foreign exchange transactions. This definitely includes Hong Kong dollar and Chinese renminbi. So that trading pair there is going to add to this, even though it's basically the same country. For the pro CCP folks out there, probably not many among my readers, the renminbi share is a joke. It still ranks below the euro, the British pound, and the Japanese yen. And I don't think anybody thinks the British pound is going to be taken over as world reserve currency. Why would the renminbi? It's worse off than the dollar. You can see in this chart, just makes it a little more clear. The US has about 60%, and renminbi is growing slightly, but again, it includes things like Hong Kong dollar to Chinese yuan. And euro is maintaining roughly the same level here. Okay, while the USD share of foreign exchange reserves has fallen slightly since 2016, it's still stable since 2020, and it even ticked up over the last year. This is still much higher than the modern era low of 46% in 1991. So if you go on a long, this only goes back to 2017, but if you go back to 1991, you'll see that US dollar share of FX reserves was down at 46%. This is before the euro, right? Before the euro was even introduced for trading, electronic trading, or issued, or anything. And the US dollar DXY was measured against all of those other currencies. The German mark, the Italian lira, the Spanish, peso. And so like all those other currencies were measured against the DXY. And now the major one is the euro. That's why the euro is 60% of the DXY, because it combined all those other currencies into one. But I mean, we're not at a historic low for the dollar or anything. That was 46% back in 1991. We're actually up. So it's not going away. This site also has the section on the BRICS swap lines and their cross-border international payment system. That is CIPS. That's a competitor to the US operated CHIPS. And this stands for clearinghouse, I think. Clearinghouse International Payment System, something like that. But it's Kind of funny, to be honest. Chips settles $1.8 trillion per day. After 9 years, SIPs totals are pitiful. If we look at all these, so Brazil, let me, sorry, Telegram, I'll make that bigger. So China with Brazil, 30 billion, but they only have one bank in SIPs. And remember, this is 9 years of building this. Russia, 2.8 billion, tiny amount in swaps for Russian banks. India, zero swaps and zero banks. This is not a good relationship, China and India. Okay, how about with China? They have zero domestic. I don't know if they would even put that on here, but chips for the US here is domestic and international of 1.8 trillion. So you would expect there to be some domestic stuff here in China, but there's not. Of course, there's 119 banks in China on SIPs. And then with South Africa, the last big one, there is 4.8 billion in swaps, still a tiny amount, more than Russia, but much less than Brazil. And they have 3 banks in SIPs. So after 9 years, the total amount of international swaps conducted by BRICS, this is on an ongoing basis, is only 37.6 billion. That's compared to 1.8 trillion for chips, with just 8 banks outside of China participating in the official core BRICS countries. So, of course, there are other BRICS countries, but they are the same. I just didn't want to go through all of them here. I just wanted to add the big ones. So there you go. Conclusion: the narrative that the US dollar is losing its dominance is complete fiction. Despite the noise, Chinese-built alternatives are struggling to gain any meaningful traction on the global stage whatsoever. Meanwhile, the dollar's role in global finance remains firmly entrenched, supported by its deep integration into international trade, foreign reserves, and forex transactions. A change to a new global reserve currency or even a significant competitor is not going to save the world from the economic troubles coming. It would only be a sign of global depression when there's not one standard that unites international trade. So if you think about that, there is a common concept in Bitcoin about convergence. Okay, the market will converge on one money, the best money, most likely, because there's an opportunity cost to holding other money as a store of value. So you hold the best store of value as money, and then that becomes the money of the medium of exchange because of the convergent properties of money. So if you find yourself in a situation where there's more than one major money, more than one standard. So what I say here is if there is a significant competitor, if the US dollar shrank to 40% and then there was another 25, 30% competitor in there, maybe a couple 25% competitors, something like that, that would not be a benefit. That would be a negative. So it'd be a sign of global depression that we can't unite around one standard. And that's coming. That's definitely coming. We're not going to be able to unite or stay united around one standard, most likely because of geopolitical reasons, not because of business reasons, not because of market reasons, but because of geopolitical reasons. So, yeah, that's what I'm saying there. Looking ahead, the potential integration of Bitcoin into the dollar's strategic reserves, as proposed by the leading candidate for US president, could further strengthen the dollar's position as cracks worsen in the global financial system, and not just cracks, but malfunctions. The global financial system is a finely tuned machine to expand credit and financialize the world. Well, when there's malfunctions around that, when it's not growing, it's dying, right? You have to continue to grow to meet principal and interest payments. If you don't continue to grow at a nominal rate, I don't know what it would be, 4 to 5% globally, then you start having the deflationary pressure starts winning out. And then you start actually deflating and credit goes in the other direction. So you have to have this minimum level. And that is due to malfunctioning in the credit system, in the finely tuned machine to crank out new credit something's going wrong with it. So that's cracks and malfunctions that are going to worsen in the financial system. It's more likely that the dollar will adapt by adding a Bitcoin backing. So if the dollar backs with Bitcoin, all of these dollar bears are going to be wrecked overnight. Okay, that was that one. Let's go into the one real quick. This will be real quick. The Bitcoin minute levels of Bitcoin awareness. I just love this cover image, actually. Midjourney did a great job on that. The Bitcoin journey for people. All right, so I saw this from Bitcoin for Freedom on Twitter. He had 6 levels, but I think that he had them out of order. Someone else on our Telegram group, he pointed that out first, saying that level 3 should be 1. I'm too late to BTC. Or no, is that what he said? You said, yeah, someone else said put level 3, put 1 as level 3. So put 2 up, 3 up, and number 1 in the 3 spot. Anyways, I did my own here. Let's go through this real quick. So level 0 is what is Bitcoin? Misspelled. Because this was the common spelling of Bitcoin back in like 2012 or 2013. What is Bitcoin? That's level 0. Level 1 is BTC is just gambling. I mean, lump all crypto with Bitcoin. It's just all gambling with Ponzi schemes and multi-level marketing. Like that's all the kind of the same sort of thing that people see on when they're at level 1. Level 2, Bitcoin is a cryptocurrency. It's just one of many. There's so many applications, blockchain, all the things, and you want to tell people about it. That's level 3. Level 4, you hold a few of the big because you got screwed on all these things. Okay. Now, along the way, there's wreckage. So maybe between level 3 and 4, you get wrecked on all your tiny little crap NFTs and ICOs that you have. And so then you consolidate just to the big boys. And you say, oh, yeah, I'm super smart. I just hold 4 main cryptos, Bitcoin, Ethereum. I'm equally diversified. Like you think you learned something from this, and you did. You learned a little bit, but you still, like, a lot of people are just too proud to like say the Bitcoin maxis were right all along. But then they finally learn. So then the next level you have is what is money. Okay, why am I holding this thing? And 4 years goes by in a cycle. Maybe you're still at the same place you were before on your total net value. And you're like, man, I need to really start digging. Maybe the maxis were right. What is money? Oh my God. Yeah, it's only about Bitcoin. So that's level 6. So this is pretty much where Bitcoin is freedom got to. Well, he got one more actually. So you hold only Bitcoin there. Then level 7, Bitcoin fixes the world. Central banks are evil, and you have to tell everybody about it. Now, this is the most common level that people stall out on, I think. That you have this is a common trajectory of where, in Bitcoin, how people usually come to Bitcoin and learn about things, but then they pause. They get stalled out on this level right here. And that's Bitcoin Twitter right now. Bitcoin Twitter is very much so stalled out here. Of course, then you'll get some of your voices that are questioning some of these narratives. I think Joe Carloseri comes to mind. A few people out there are real kind of against the grain. I consider myself in that group that question this narrative. And what we're trying to do, I think Joe would probably agree with this, that we kind of dissonant people that we want you to move down the levels. We want you to keep going. We don't want you to get stuck on this where Bitcoin fixes the world, central banks are evil, and you want to tell everybody about it. Because there's things in here that you can't explain. It's kind of like when I was talking about the technology. You come to a dead end when you start coming across evidence that doesn't fit your model. Okay. Then you just hand wave it away. Like, I think Peter Schiff has just hand waved away all of this contrary evidence to his to his wrong assumptions. He just hand waved it away. Well, people get stuck on this level 7. Peter Schiff is on this level 7 for gold. Okay, let's keep going. Level 8, someone should do something about the scams. I didn't know if I wanted to include this, but really you start questioning that this should be a free-for-all, because you see so simply that these are all scams and that you shouldn't allow fraud. Like force and fraud is one of those things that are not good. They should not be allowed. And that this is, someone should do something about the scams. That goes against this ethos that some anarcho-capitalists, early adopters to Bitcoin, they seem not to be able to get to this level. So this is kind of a jump, actually. From level 7 to level 8 is a jump, but it's more than a jump of your understanding of Bitcoin. It's a jump in your realization of a deeper part of the world. And that's where these next levels start coming in. So level 9, incentives are everything. This is not just money incentives. This is everything incentives. This is partners, romantic partners, wives, finding your spouse. This is what's right for your kids. Long-term, short-term incentives. Everything is about incentives, and this is level 9, understanding that Bitcoin aligns incentives, but really in nature, everything is about incentives. Okay, level 10, we are in repeating generational cycles. Just understanding that you're not special. You're part of a repeating system, and you can learn about the present and the future by studying the past and understanding what kind of these generational cycles we're going through right now. Level 11, Bitcoin is not good or evil. It's a tool. This is a neutral claim versus Bitcoin fixes the world. That's a proactive claim. This is kind of a neutral claim. Bitcoin is not good or evil. It is a tool. It's not ruled by anyone. I could have put it's an element on the periodic table. It's neutral. It is there. It could be that it's there for decades and decades and decades, and the market just doesn't come around to it. But it's sitting there as a tool for anybody to use. Maybe only a small amount of people. Maybe we have capped adoption for now, and now we're going to wait for 20 years until maybe adoption picks up again. Whatever the case is, it is a tool. It's a neutral tool there for humans to use. And level 12, natural market evolution creates the incentives that make Bitcoin inevitable. So why will we move to using this tool? Well, because the market evolution, changing the incentives that are everything. Okay, so that is the global perspective of where Bitcoin sits. So that's kind of some more of my thoughts here. I won't go through those, but of course, these aren't end all be all. These are kind of just what I came up with over an hour or so thinking about it. And yeah, so check out that post as well. Let's go back to the homepage. Guys, if you're watching, check out bitcoinandmarkets.com. Make sure you're subscribed to at least the free tier. Let's see some more comments here. Dex Invictus says, Peter Schiff is still hilarious. Yes. Okay, no new comments. Let's check out. Rand. Ansel is a tool. I'm a neutral tool. I am a neutral tool for your use. Okay. That's it, guys. Thanks for joining me. Again, check out bitcoinandmarkets.com. So like, comment, subscribe on all the videos on YouTube and Rumble. Those links are in my pinned tweet. I'm also on Instagram, True Social, Nostr. Where else you can find me? Twitter, of course. Find me on all those platforms and follow me. Appreciate you guys. And I'll see you on the next one. Peace.